Yeah, today I'm going to be talking about the valuation of insurance for mergers and acquisitions. I will be talking about things from an actuarial and a rating perspective. I'll begin just by looking briefly at the various stages of a transaction, focusing on the role of the valuation specialist in facilitating a transaction and supporting it. Then I will review the primary valuation techniques being used currently. I will focus then on market valuation drivers. It will be interesting to note that there is a lot of interest now being generated by the potential of IPOs in Saudi Arabia. Jordan has a requirement as well that all life insurance companies must be listed. So I think it's important to pay some attention to valuation of insurance companies in a market-listed environment. Then I will turn to the specifics of the transaction dynamics. Again, looking at specific aspects of the valuation that relate specifically to the transaction that is underway. And finally, then I will turn to the conclusions. Stages of it's interesting to note that several stages of a transaction require the input of the valuation actually, both at a very early stage, for example, in making a pre-bid value assessment of a company, in identifying the risks. Of course, the valuation actually will be very close to the risks because they would have to be factored in the valuation of a company on a standalone and on a merged basis. Then I will look at, then of course, the valuation actually will be responsible for actually valuing all the entities being targeted. And we will then also look at synergy identification and valuation, which of course relates to valuing an insurance company, particularly in an M&A context. Because it's one thing to value the insurance company on a standalone basis, but of course, when a deal is being proposed, it's particularly important to focus on the synergies that are expected to arise from that deal and to value those synergies properly. Because very often, of course, that is the most important justification given for a deal. Without the synergies, the deal shouldn't be proceeding. Then, of course, the valuation action will also be involved in assessing the implications of any financing options and the structuring options that facilitate the deal. That could also have then an implication for the valuation of the deal. In assessing, in valuing an insurance company, as I mentioned already, it is very important to take into account all the risks that would relate to any insurance business, and of course, in addition, risks that arise particularly as a function of the M&A being proposed. So this is the standard breakdown of risks that relate to insurance companies used by the International Actuarial Association, and it covers both product risks and non-product risks. The product risks relate to the core insurance aspects of underwriting aspects of an insurance company, whereas the non-product risks relate to broader risks that you would find in any business. So it's interesting to note that, for example, operational risks in an M&A context are particularly important, and our distinguished speakers already referred to those operational risks. Now those need to be taken into account when valuing a company, and we will see how that will be factored into valuations later on. Now turning to the valuation techniques, the major valuation techniques being used currently for valuing insurance companies are twofold. The one can be referred to as an adjusted net asset value, And the adjusted net asset value is based primarily on disclosed balance sheet information, which is then adjusted to reflect the particular circumstance of an insurance company and also to reflect changes in the market value of invested assets sitting on the balance sheet of a company. So in simple terms, we would take the adjusted net asset value would be equal to the disclosed shareholders fund of the company. To that we would add any unrealized gains on the shareholders' assets, which are not currently being reflected in the balance sheet. We would then deduct from that value any goodwill that's sitting on the balance sheet, for example. An example of that would be advertising expenditure that has been capitalized on the balance sheet. Now, for valuation purposes, that would be considered to be an intangible, so we would exclude it. And also, another very important intangible would be deferred acquisition costs, which really represents the deferral of costs incurred by a company in writing new business. As you would be very well aware, a lot of the costs are incurred upfront and then are recouped over the lifetime of the contract, and very often the company uses that to defer some of the costs and thereby creating an asset on the balance sheet which is referred to as a deferred acquisition cost. Now, we exclude it from the adjusted net asset value because we then make explicit allowance for the present value of expected profits from all in-force business on the balance sheet. And the expected profits from the in-force book are really the value of the margins that are expected to emerge in future from the business that already has been written by a company. Now, one thing I'd like to emphasize in this context is that in a regional context, the adjusted net asset value, as I've described it here, is equal to the embedded value. And that is because we very rarely see companies that have operations sitting on their balance sheet that are have a life of their own. And I'll give an example of what I mean. In South Africa, for example, many of the insurers that dominate the market are giants, and they own their own asset management operations. Now, those asset management operations have a fair value of their own, but they are components of the net asset value of the insurance company. Now, on an adjusted net asset value basis, we would just look at the net asset value of those asset management operations, and we would only add that into the adjusted net asset value of the entire insurance group in calculating the adjusted net asset value. But if we wanted to actually calculate the embedded value of the insurance operation, then we would need to assess the fair value of that asset management operation on a standalone basis. Now, in a regional context, we rarely see that. In the regional context, 90%, the vast majority of the assets sitting on the balance sheet are actually invested assets, and the value of those investments would be taken as the value reflected in the balance sheet without making any other adjustments in going to a fair value. Now, in addition to this valuation technique, we would also look at what we refer to as the sum of the parts. And the sum of the parts can broadly be described as the present value of future expected cash profits emerging from the insurance group's operations. Now, this is a much broader definition, and the most important distinction between the sum of the parts and the adjusted net asset value is that you will note that in the case of the adjusted net asset value, we only look at expected profits from the in-force book, from the business that already has been written. So we ignore future new business completely. Whereas in the case of the sum of the parts valuation, we would look at all profits, including those profits that will emerge from business that hasn't yet been written. So that is those are the major valuation techniques that are being used globally in assessing the value of insurance companies. Now, I'd like to delve further into embedded values and appraisal values. In just linking the two, the embedded value, as I've described already, is equal to the adjusted shareholder equity plus the value of in-force. Moving to the appraisal value, we basically have to add the franchise value to the embedded value. And the franchise value is determined by looking at the value of new business that we expect to write in the year that's coming, assuming that we are at the end of the financial year, and applying a growth multiple onto that value of 1 year's new business. So really, it's the value that we attach, not on business that already has been written, but on the ability of the company to generate profitable new business going forward. And another way of describing that is as goodwill. Now, very importantly, assumptions play a very big role in calculating the value of in-force, the value of margins that we expect to arise from business that's already on the books, which of course is an important component of the embedded value. As you would ascertain, the value of in-force is a present value calculation. So we are projecting future profits that we expect to emerge from the business on the books, and then we are discounting those profits to today. Now, obviously, the value of those profits very much depends on the assumptions that we make regarding inflation, regarding expense levels, regarding persistency, mortality. Specifically, when we turn to the economic assumptions, and here I give an example of a set of economic assumptions that were used in the first half of 2003 by two UK companies, Aviva and Prudential. The relationship between those assumptions is very important. So, a typical set of economic assumptions will include future investment returns, expense inflation, interest rates. Now, all these assumptions must be consistent with each other. If there's an anomaly in the consistency between the assumptions, then that will be reflected in an erroneous valuation. So it's really not important what the absolute level of each assumption is. What's more important is what the relative value of each assumption is. So if we allow a higher investment return, then that would need to be also reflected in a higher inflation rate. We would expect higher nominal investment returns to be associated with higher inflation rates. Now, higher investment returns will have a positive effect because you will be projecting higher cash flows. Higher inflation rates will have a counterbalancing negative effect because you will be projecting higher future expenses. Also, the discount rate that you use has to be consistent with the projected investment return that you use. Because again, the discount rate, which reflects the cost of capital from a shareholder's perspective, that is the return that the shareholder expects from by being invested in an insurance company, that the expected return will change as the expected investment return changes in the underlying policyholder funds. So consistency is very important in setting the assumptions. And the assumptions can be either passive or active. You'll find some companies that take a very long-term view on what assumptions to use, whereas other companies link the assumptions that they use to the underlying return on yields. So they'll look at what gross redemption yields are available on fixed income securities, and they'll link all other economic assumptions to that underlying market parameter. And all the assumptions then will adjust consistently as the yields on yields change. It's also important to note that the important profit drivers vary by type of contract. So you could have certain contracts where investment returns are very important. For example, an endowment, a with-profit endowment. Whereas for other contracts, like for example, a term assurance contract, a level term assurance, assumptions like persistency, mortality, expenses, level of expenses are much more important than the investment return assumption that one makes. In setting the discount rate, one final point on this issue, the risk margin that we incorporate in the discount rate that we use to calculate the present value of future cash flows should reflect the riskiness of the future cash flows. And the risks that we will take into account would be very similar to the risks that a credit rating agency takes into account in assessing the financial strength of an insurance company. For example, the size of the company, the spread of its business, its competitive position, the reliability of its track record. It's interesting to note now, turning to the second component of the appraisal value, and just to recap, we've said thus far that the appraisal value is equal to the value of in-force plus the value plus the franchise value, which is so we say that the embedded value is equal to the adjusted shareholders funds plus the value of in-force. We then said that the appraisal value is equal to the embedded value plus the franchise value of the business. Now, a very important determinant of the franchise value of the business is what new business profit multiple we use. And the new business profit multiple will reflect two things. It will reflect the growth rate that one assumes, the future growth rate in new business volumes that one can expect, and new business profits, and also the discount rate that one applies to those future new business profits. Now, we would expect the discount rate that is applied to the franchise value component of the embedded value to be higher than the discount rate that is applied to the value of in-force. And that is because the uncertainty that is associated with the new business, with future new business, the level that will materialize at, the profitability of future new business, the uncertainty relating to all those factors is greater than the uncertainty that relates to the in-force book. So it would be unreasonable to expect that the discount rate that you would expect on the in-force business would be lower than the discount rate that you would expect on the new business component or the franchise value of the appraisal value. Now, putting that growth rate assumption, the growth of future new business profitability, together with the discount rate, gives us the new business profit multiple. So we would use, say, if we roughly were to assume a growth rate of 5% and a multiple of and a discount rate of 12%, we would take it in perpetuity. We would get a multiple of 18 times that would be applied to the value of new business. Now, it's interesting to note here, I give examples on this slide of the new business profit multiples that were used by an investment bank, Morgan Stanley in the US in September 2002. You will note that in getting to their appraisal value of Swiss Re, they took the value of projected 1 year's new business, the value of profits that they expected to emerge from 1 year's new business in the year to come, and they applied a multiple of 18 to that value to get to the franchise value component of that Swiss Re's appraisal value. Now, that gives you a sense of the significance of these assumptions. Obviously, if you were to change the growth assumption that you make, or the profitability assumption that you make in projecting the value of new business, that 18 could change very significantly. The 18 also may seem high to you, but it could be reflected by the fact that, if you think about it, September 2002 followed a very difficult period in the life of reinsurance companies. Their business profitability had been hit by the September 2001 attacks, so the base profitability was at a low level. However, looking forward, reinsurance rates were hardening, so the future profitability potential of a reinsurance company in September 2002 looked very good. So you were applying that very positive expectation to a low base current profitability, and that's what resulted in such a high multiple being applied to the value of 1 year's new business currently in getting to the franchise value, which really reflects the future value of all new business that one expects Swiss Re to be able to write going forward. Now, in looking at these multiples that get us to the franchise value, it's important to also keep in mind the various mechanisms that companies use to artificially inflate their appraisal values. One trick, for example, that analysts were very well aware of in 2001 and 2002 was that companies were using surplus funds sitting in their policyholders' funds, in their with-profit policyholders' funds, to write loss-making business. So what was referred to as the inherited estate, that is surpluses that have accumulated from past generation of policyholders in the policyholders' funds that haven't been actually distributed to any particular tranche of policyholder, were there for the taking. If an insurance company did nothing with those surpluses, they wouldn't be reflected in its embedded value because they were part of the policyholders' funds. So the insurance company had no right to touch those surpluses. But one trick to access those surpluses would be to use those surpluses to write future generations of new business. So those surpluses were used to finance what were in essence loss leader tranches of business. Once you had written that a certain amount of business on your books, then the analysts out there would apply a multiple on that value of new business, and so what was previously part of the inherited estate that wasn't reflected in the fair valuation of the company was now transferred to the franchise value, so it was actually being used to boost the valuation of companies. And this is the typical breakdown of those policies that were written. And the diagram shows clearly that if you were to take the premiums plus investment return that were being accumulated, they very often, in the UK as a particular example, very often those accumulated values were not enough even to cover the guaranteed benefits, expenses and bonuses that a policyholder would expect, taking policyholder reasonable expectations into account, which were of course a very important constraint in the UK environment. So a company was not making any allowance for tax, profits, guarantees, was only really making partial allowance for expenses and bonuses, but it was still willing to go ahead, knowing that if it were to destroy any capital, it would really be the capital of the policyholders' funds, of policyholders, and in the meantime, they would still get the benefit in terms of boosting the valuation of the company. So that just gives you a feel for how these numbers can be very easily manipulated by companies to serve the interests of a particular party, in this case the shareholders. Turning to embedded values in a non-life context, I think this is an important topic, and it's an important topic that users are only really now becoming accustomed to. Normally embedded values are only associated with life insurance companies. But there is nothing to say that this technique cannot be applied to accurately value the portfolios of non-life insurance companies. In fact, I believe that very often non-life insurance companies are being unfairly valued because in looking at their portfolios, valuators only see that the portfolios are annually renewable. So if you think about it, if you want to draw a comparison with the situation on the life insurance side, it's as if a company is writing new business that represents its entire portfolio every year. It's as if its franchise value is being renewed every year. Now, the problem with that is that we know that valuation actions would normally apply a higher risk discount rate to future value, to future new business, because of the uncertainty relating to that business. We've already discussed it. But the problem with an existing non-life company is that if it has a strong franchise, if it has good control over its pricing and its distribution channels, and if it has demonstrated high persistency levels in the past, then in effect it is in possession of a viable in-force book that has a value. It may lose, say, 20% of its portfolio every year. 20% of its portfolio may be cancelled. But the bulk of the portfolio may be renewed from year to year on a consistent basis. So that has value that needs to be captured in a value of in-force. And the risks pertaining to that component of value are lower than the risk pertaining to new business being written where the uncertainty is obviously greater. And that's why it is very important to introduce an embedded value approach in valuing insurance companies to make sure that they are valued fairly. So the embedded value pertaining particularly to non-life insurance companies should cover the net asset value, as we've discussed previously, for life insurance companies, should cover the value of future underwriting profits. So that is the profit that we expect from the core insurance business. And in addition, should cover the value of projected investment return on the free float. Now what I mean by the free float is the cash flows that the company gets to manage as a function of writing insurance business. And that is a very important component of value. I mean, you'll find that if you look at combined ratios, for example, in the UK, year after year, combined ratios in the UK exceed 100%. So you'll find that they sit around 102%, 103%. Those are the average combined ratios on the portfolios being written in the UK. However, that doesn't mean that the insurance companies in the UK are not viable operations. What makes all the difference is the free float effect. What makes all the difference is the investment return that they make on the cash flows that they manage. A particular reference to the UK is that, of course, if you look at the dynamics of that market specifically, a lot of commercial business is written in the UK. And that is written very often on an annual premium basis. And that means that companies have great opportunity to manage the cash flows between actually receiving the premium and actually incurring a claim. So again, the free float effect in that case on the commercial side would be greater normally than the free float effect on the personal line side. Another factor, of course, to consider in valuing the free float effect is the length of the claim tails. And of course, that is in turn a function of the type of business. If you're looking at short tail type of business, motor, health, most motor, most health, that's very short tail. The opportunity to play around with the amount of money, to invest the money while you have it before paying claims is much less than in the case of long tail liability claims, for example. But I cannot emphasize enough how important it is to explicitly value the free float in assessing the overall valuation of an insurance company. So now, just in putting everything together, we've discussed embedded values, and we've discussed the various components of the embedded value, the NAV and the value of in-force. This diagram here just seeks to make a comparison between various ways of accounting for when looking at the balance sheet of insurance companies. You'll note that on the left we have an example based on statutory accounting, where we would normally not allow for any future margins, where the basis would be relatively more conservative. We wouldn't be allowing for any, for example, deferred acquisition costs. The next level is deferred acquisition accounting, where we make partial allowance for margins that are expected to emerge on business being written. So we incur acquisition costs in writing new business. We pay commissions, we pay administration, high administration fees, getting the business on the books. But because we expect margins to emerge on that business while it's on our books, we take partial credit for that, and as I've referred to already, that will be described as a back asset, and that will be used to increase the asset side of the balance sheet, thus inflating the shareholders' funds, the adjusted NAV. Taking it to the next level then, we move on to embedded value accounting, where the asset side of the balance sheet would include the in-force value of the business in its totality, not limiting ourselves just to a partial allowance for future margins that we expect to emerge in order to recoup acquisition costs, but in a broader context, looking at all margins that we expect to emerge on the in-force book. So that gives you just a quick view of all the various accounting jurisdictions and how they would be reflected on the balance sheet. Now I'd like to turn to market valuation drivers. And again, I'm happy that our distinguished speakers and members of the audience already made reference to the IPOs that we expect in Saudi Arabia. Thus far, I've dealt with valuations in a more theoretical context. Now it's important to turn also to the reality of market valuations, where fund flows in and out of a market, in and out of a sector, can have a very big impact on the actual valuation of a company, particularly in a context where we see very often low liquidity levels being a challenge in stock markets in this region, and where, as a result, share prices can be manipulated very easily. I'd like to begin with an example in South Africa. Looking at here, what this shows is the price to appraisal value ratios of the major 4 insurance companies in South Africa between September 2000 and June 2002. Now, the interesting point here is that we may come up with a fair valuation of a company, and the appraisal value here, it's important to note, was actually marked to market. So the appraisal value of each company here were actually adjusted on a day-by-day basis to reflect changes in the value of the underlying constituents of those appraisal values. So they were actually very close to reality. But even so, when the market looked at how it should value these insurance companies, the market came up with a valuation that was very different from the fair value. And you'll note that all the companies in June 2002 were actually trading at a very significant discount to their appraisal value. Now, there were several reasons for this. The most important reason was that when I discussed long-term assumptions for embedded values, I emphasized exactly that, the fact that there are long-term assumptions. They reflect long-term expectations about investment returns and inflation rates, etc. So they reflect the long-term average outlook problem is that when you look at market valuations in a stock market context, the time horizon is much shorter. So an investor on the stock market is more interested in what's going to happen over the next year. Now, in June 2002, there were many concerns about the equity market in general and the investment returns that investors can expect from equity markets in the very short term. And there was a concern that stock markets were still overvalued, stock markets were coming down. These insurance companies were exposed to those stock markets. So even though we were tracking the market values of their equity holdings, for example, of their stock market holdings sitting on their balance sheets, the momentum was a downward one. Now, as a result of that negative environment and the negative sentiment resulting from that, investor sentiment, all the valuations were heavily discounted relative to the theoretical fair value. In addition to that, of course, there were other company-specific concerns. For example, New Africa Capital was considered to have very poor management. So investors hated it as an investment vehicle, and they were exiting the company. So there are two issues again that I'd like to emphasize. The issue of the time horizon, remembering that the appraisal value is a long-term estimation of value, whereas stock market valuations are driven more by short-term considerations. And then in addition, there are company-specific issues that can have a major impact on investor sentiment relating to a particular company. And these need to be kept in mind. Of course, that doesn't mean that this isn't relevant even in the case of a non-listed insurance company. If you're looking at an insurance company as an example, that and very often the sellers of that insurance company will make sure that they show the best results possible in the very short term, because of course that will have a very positive impact on sentiment. If they have a very bad year, coincidentally, at the same time that an investor shows interest, then obviously that will impact the valuation, and that could have a disproportionately high impact, in fact, on the valuation, even if the medium-term value of a company is actually much greater. So it's important in valuing companies, in looking at fair values, to make adequate allowance for the additional quantitative and qualitative valuation drivers that impact the valuation of companies. And this is relevant both in a listed environment, listed entity environment, and also when dealing with non-listed insurance companies. The considerations should be the same. In fact, even in an environment where one has listed and non-listed insurance companies, in valuing the non-listed companies, the valuations of the listed companies would definitely be used as a benchmark of what value to place on the non-listed companies. So here I'll just give some factors, some drivers under certain headings, beginning with life. An example of another parameter that would be closely tracked by analysts, by valuation specialists, would be something that is called the value of in-force margin. I already described the value of in-force. Now this is the value of in-force divided by the value of liabilities. So that is basically the value of future margins relative to the size of the liabilities of a company that are actually giving rise to those margins. And that would be tracked very closely, looking for any deterioration or appreciation in the value of in-force margin. Another very important measure that's tracked very closely is the return on embedded value. That is the growth that the embedded value generates that is generated in terms of embedded value relative to the size of the embedded value. And that would be compared with the discount rate, which can be termed as the cost of equity or the cost of capital of an investor considering an investment in an insurance company. So comparing those two factors can give us insights into whether a company should be trading at a premium to its embedded value or at a discount to its embedded value. If, for example, roughly speaking, a company is year after year generating returns on embedded value that are lower than the cost of capital, then you would reasonably expect that that company should actually be trading at a discount to its embedded value. As very often happened, and I gave South Africa as an example, where there was the expectation that investment returns would be negative in the short term. That would in turn lead to negative embedded value growth. In fact, embedded values were going down or were flat. Relative to the cost of capital, relative to the investment return that an investor would demand in putting money into a relatively risky insurance company, that was lower. So in return, companies were actually trading at a discount to the embedded value. Turning to non-life companies, we will look at the profit potential, particularly in a low investment return environment, which still is very much with us currently. So companies now cannot rely as much as they could in the past on hefty investment returns to support their overall performance. So there is now greater focus on their underwriting performance, both current and potential, and in turn that is a function of the stage at which they are in their underwriting cycle. Another very important parameter is reserve strength and monitoring reserve strength. One company may look healthier than another, but in fact its net reserves relative to its net premiums may be declining. As a result, the reserve strength may be an important issue to look at. And finally, a theme that's very close to my heart is that of financial strength. We have absolute capital strength, which really looks at the available capital relative to the required capital on a risk-based basis. And then looking at the development of that capital strength over time and assessing the sensitivity of the capital base to various scenarios. So these are all the supplementary methodologies that are used to more comprehensively value an insurance company at a particular point in time. The return on embedded value specifically is given here in more detail, and that basically looks at the embedded value at the end of the year, less the embedded value at the start of the year, but after eliminating all these items that don't relate to the core sustainable performance of an insurance company. Remembering that, as I said previously, the actual embedded value that a company shows from one year to the next can be impacted very significantly by the assumption that one makes in calculating the value of in-force. So one company can show very good embedded value growth from one year to the next, but just because its assumptions became more optimistic from one year to the next. Obviously, from a valuation perspective, a valuation analyst will not give them credit for that. Therefore, the impact of any assumption changes would be eliminated. There are other supplementary then key performance areas that one would look at as valuation drivers, and the list continues. Parameters relating to sales growth, annualized premium equivalent, APE, which is very important in the case of life insurance companies that drive both single and recurring premium business. Remembering that a higher weight needs to be applied to recurring premium business than single premium business. Parameters relating to profitability, profitability on various bases. Even statutory profits may be actually relevant because they determine what dividends a company can pay. And particularly for listed entities, the dividends that they can support are very important. They have a direct impact on investor sentiment. And we expect to see that even in Saudi Arabia. We expect to see that companies will will try and maximize very often the dividends that they can pay, even if those are not sustainable in the medium term, because they'll be very concerned to maximize the valuation they achieve on the market, and that's the direct function of the dividend yields that they offer to investors. Turning now to financial strength in more detail, we saw in the months running up to August 2002, and this was a period where financial strength of insurance companies was being questioned, and that's why I've chosen to look at this period specifically. And you can see that the spread over government bonds, looking at the euro-denominated bonds, increased significantly. So corporate bonds issued by insurance companies were offering, or had to offer, much higher redemption yields, much higher yields, in order to allow for the risk, the credit risk associated with those corporate bonds. And that's what that arrow indicates. In the case of the sterling-denominated bonds issued primarily by UK-based companies, again, the pattern was very similar. In the period running to August 2002, where equity markets were collapsing, where balance sheets were coming under pressure, again, you had those yields shooting up. So investors were definitely very concerned about the financial strength of those insurance companies. You can see that at the same time, the price to NAV ratios, the price to adjusted NAV of those companies were coming under substantial pressure. But it's even more interesting to note that the companies that were less well rated were actually coming under even more pressure. So that means that investors were actually monitoring the financial strength ratings being granted to companies. And the lower ratings were being reflected in higher valuation discounts. And that's what showed. You can see that in the case of a AAA rated company, the AAA rated companies that are the line are represented by the line on top were trading at a premium to their peers that were, say, only rated A+. Now, why should there be such a close link? The link is obvious. When we look at financial strength, we assess the balance sheet strength of the company currently, and we look at the outlook for future balance sheet strength. And the outlook for future balance sheet strength is very much a function of the quality and sustainability of a company's operating performance. So it's very reasonable to expect that the same factors, the same issues that drive the valuation of a company are also driving the financial strength rating of a company. So there should be a very close relationship. Over the same period, one notes as well that if you were to track the adjusted NAV versus the required risk-based capital of the companies given here as an example, over time the adjusted NAV declined relative to the required risk-based capital on average. So each line represents a year, and you'll see that for 2002, for most companies, the yellow line is lower than for the other years, which means that, again, because of the investment conditions, because equity markets were coming under pressure, because balance sheets were coming under a lot of strain, the NAV of those companies were declining relative to their theoretical required capital. And as a result, their financial strength ratings were coming under pressure, and in turn, as a function of that, their market valuations were coming under pressure. Just to finally conclude, I'll look briefly at the transaction dynamics relating to an insurance company. I've already shown the slide that deals with the various stages of a transaction. It's very important to adapt the valuation process to allow specifically for the circumstances relating to M&A activity. And the very important element that really differentiates normal everyday valuations from valuations relating to M&A is that in the case of M&A, the valuation actually needs to specifically focus on the net value of synergies and how these will be attributed between the buyer and the seller. The seller, of course, expects a control premium for giving away control to the insurance company, and the buyer expects to gain some synergies from actually continuing with the transaction, from actually proceeding with it. And here I just give an example of the various components of value, or in this case, a company worth $30 million is acquiring a company worth $15 million on a fair value basis, but is willing to pay $20 million. So the control premium is $5 million, whereas the synergies, the net value of the synergies is 4 plus 4.5, that is $8.5 million. And that means that if you go right to the right-hand side of the chart, the merged entity then will be worth $45 million plus the net value of the synergies. Looking at the decomposition of the acquisition price, more in insurance terms, the important thing to consider is that, particularly if you're dealing with a listed entity, the minute there is even suspicion of a deal, there will be a control premium in the valuation. In addition to that, there will be another control premium when it comes to actually finalizing the deal. The two control premium put together must not exceed the value of the synergies that are expected from the deal, otherwise the deal will be equity dilutive for the shareholders. Here I list the potential synergies, both on the revenue side and the cost side. Of course, in the short term there will be significant costs associated with the deal, but hopefully those will only be temporary in nature. For example, staff may have to be laid off, retrenchment packages may have to be granted, executives may have to be tied in by offering them generous packages. So the cost may increase in the short term, but in the medium term, you would expect significant cost synergies to emerge. Of course, all along the way, all the risks specific to merger and acquisitions must be kept in mind. There could be conflicts arising from cultural differences. I mean, our distinguished speakers already dealt with many of these risks specifically, so I'm not going to dwell on this point. But these risks must then be taken into account in actually valuing the entity being targeted. To conclude, we've shown that the valuation actually plays an integral role at various stages of the M&A negotiation process. Clearly, the appraisal value methodology is the preferred technique to be used, as it is the most comprehensive. Other valuation drivers may result in significant discounts or premiums to the theoretical value, and those must always be taken into account, always keeping in mind that investors have a different time horizon from the long-term time horizon factored into embedded values normally. And of course, careful consideration must be given to valuing the revenue and cost synergies equitably before finalizing all the acquisition terms, keeping of course all the relevant risks in mind at all times.
Thank you, Chris. And we'll open the discussions for the floor. And I ask Chris to stay standing up. Mr. Shamas.
Thank you, Chris. Very good presentation as usual. I'm quoting you. Appraisal value is a long-term valuation, unquote. The new loans are George is not, was suggesting that 25% of the stock of the company I understood what from George today is that this process should be done at the beginning. I don't know how you feel about it. I don't know whether there is enough time to evaluate a company as an investor to be able to invest in it. I don't know how any investor could know how much to pay for each share. Don't you think that this process could be better managed and better and more profitable to the investor if this is done like in 1 year's time after you see how much the company is efficient in its handling the portfolio, in its launch, and etc., etc. Thank you.
Thank you, Mr. Shamas. It's a great question. The intention, I think, is to value companies and to get the investors in Saudi Arabia to participate in those companies initially at par value. So the companies will really be dealt with initially as startups without any assets or any liabilities, and a new amount of capital will be invested in those companies. That's the intention that has been communicated to us. Now, there are concerns.
Excuse me, that cannot be the case. If you had a big name without naming any names, if you had a big name with 100 million in Saudi Arabia, and a new company unknown and no goodwill, nothing with 100 million riyals, you know that most investors are going to choose the big name,
yes,
and if it's at par value. So I don't think this is what they have in mind.
Yeah. Of course, I mean, we very much we're very well aware of that. Obviously, ultimately, the franchise value of a company will have to come into the picture. I mean, if you have, as you said, a dominant franchise versus a startup operation, that difference in value must be reflected ultimately. I stand to be corrected, but I think initially, right at the start, that 25% is going to participate on par value. So from the regulator's perspective, it will be as if a new company has come into existence. Now, most companies, of course, will then look to acquire their in-force books, to transfer their in-force books in effect from in most cases, their Bahraini operations, in order to then consolidate everything under one umbrella in Saudi Arabia. Now, that's where the people will have to be very careful, because people who then at that stage have to ensure that those portfolios are valued equitably, to make sure that the new shareholders introduced into the picture do not overpay, but also to ensure that the existing shareholders that are already participating on an in-force portfolio that happens to be registered in Bahrain will receive a fair price for the franchise value of their business and for the in-force value of their business. So, and we are definitely concerned. I mean, you raise a very relevant point that very often we will not see the standards of professionalism that we would like to see in reaching those valuations.
Yeah, let's for a minute assume that those two entities do not exist, are not operating today in Saudi Arabia. A new group of investors are coming to invest 100 million Saudi riyals and name company XYZ, and next to them a very well-known international company, insurance company that does not exist in Saudi Arabia, comes in and pumps the same kind of capital. And you're saying maybe they are thinking of throwing in an IPO at the cost. The international company will have an oversubscription, and maybe if you are asking for 100 shares, you get half of a share, whereas the other company, there won't be any subscriptions or even demand on it. So how do you look at it? Do you think in 1 year's time it would be fair, or it should be done at the beginning?
Well, definitely, I mean, ideally, it should actually be done, as you said, in 1 year's time, where companies will have more of a track record. In fact, even 1 year is not enough to develop an adequate track record. So, and definitely, I mean, as I said, you raised a very good point. If you only if you assume that there were no other companies and all companies will start up operations, then I guess from an investor's perspective, he's putting in $1 of capital and he's buying $1 worth of equity at the start. Of course, it will be up to the management of those companies being established then to put forward an adequately good investment case. Otherwise, as you said, the equity issue will not be adequately underwritten. Now, we're assuming that all companies will be able to get to that 25%. Of course, the market dynamics will determine how things unfold. And if investors are not willing, then obviously the company, I guess, will have to go then back to the regulator to explain that there's not adequate interest out there. And that could then also be a constraint. But another way to look at it is that, and I think from Sam's perspective, this is quite clever. If a company cannot get enough interest, then maybe that in fact should be an obstacle to it registering. If it can't get to the 25%, maybe then something is wrong. Maybe management doesn't have a track record, maybe management can't be trusted. This is an example. So it does actually introduce a nice control mechanism, although definitely from a valuation perspective, we would have preferred it if companies had a track record already.
Perhaps a follow-up to that, we have a number, an unknown number, 70, 80, 90 general P&C companies in Saudi Arabia where mergers and acquisitions sorting out the market is going to occur. And the factors in terms of the pricing and the valuation make sense. You then have a greenfield virgin life market with companies like ourselves and a few others where the explosion in the business, all goes well, will be enormous. How do you build in the different sets of factors between the merger, acquisition, the consolidation of the general side of the business, the well-established business, with factors that are not really perhaps as clear in terms of this explosion that we expect to see in the life business? Is there anything you can enhance in terms of your presentation? Excellent presentation, Chris. Thank you.
Thank you, Mr. Definitely when you're dealing with life insurance companies, the degree of subjectivity increases. So, because again now we're dealing with the value of in-force books, we're dealing with future new business profitability, and particularly it becomes difficult to assess that value objectively when you're coming off a low base and there's substantial potential going forward. Now, of course, that would mean that in the case of life insurance companies, if the management is credible, you should be able to pull that 25% target very quickly. And obviously, then that would be considered an excellent investment opportunity by potential investors, because the upside potential is clear, assuming that management is credible and has a good track record. But going forward, of course, once the insurance companies are listed, the market will decide what value should be attributed. So, looking at the way the IPOs are going to unfold, I guess the life insurers and the quality life insurers, the quality non-life insurers will deliver windfall benefits to the initial subscribers to their respective IPOs. That is my estimation.
I think this afternoon we are going to have a session on the role of the investment banker on the IPOs as well. So I think that is probably, we'll see how aggressive the investment bankers are to make sure that the company is being
Over time, of course, yes. Once the company is listed, of course, then it will be up to qualified analysts. And unfortunately, one concern that I have is that maybe the people that will be looking at valuing these companies will not be up to speed with all the valuation techniques that would be used globally to value life insurance companies. So definitely, I think you will see in the short to medium term a lot of overvaluations, a lot of undervaluations. There will be a lot of mispricing in the market. To add to that, you're looking here at the market where the liquidity levels are low. So in the short term, there's also potential for share price manipulation. So, and a 25% free float, listing only 25% of the company, although it's interesting to note that SAMA has indicated that they would prefer if that 25% were to increase to 30, 40%. Because 25% on its own would mean that it's not going to be a liquid investment, and that means that over and above all the other theoretical valuation issues, there's significant potential for a lot of manipulation in the short term. So yeah, it will be a very big challenge to actually predict where share prices are going to go in short.
If there's no more questions, I think it's just time to have lunch. Lunch is being served upstairs in the Mosaic, and hopefully we'll be back down here by 3:30. We have 3 presentations this afternoon, as you all know, covering the reinsurance side, application for insurance, the legal, and the investment banker. Thank you very much for this morning's session.